Bismillahirrahmanirrahim. In this video, we are going to talk about capitalization rate, negative leverage, net operating income, and difference between negative net financial obligation and negative leverage. So let us start with capitalization rate. Now, one of the most common tools used by real estate investors to determine the price and value of a property is the capitalization rate, or cap rate for short. The cap rate is the relationship b- between a property's annual net operating income and its market value, or market price as we call it. Coming to the net operating income, uh, this is the income a property generates after subtracting operating expenses like taxes, insurance, and maintenance cost. So, in simpler terms, net operating income is the income you have left over after paying for the property's ongoing expenses. For example, a property owner collects rent. Now, this is a revenue in this case. They collect rent payments from tenants each month, and after deducting cost like property taxes, insurance, and maintenance, the remaining income is the net operating income for that month. So, to calculate the capitalization rate, we use the annual net operating income. Now we have the annual income, net operating income of 60,000 and the property tax of 1 million. So the cap rate is going to be 60,000 divided by 1 million, and that is going to give us 6%. So the capitalization rate is also an indicator of the risk associated with owning a property. Generally, lower cap rate will have higher property price, and vice versa. That is, higher cap rate will have a lower property price. And the reason being that if the cap rate is lower and it will have a higher property price, is that the investors expect lower returns because the property is considered less risky. In case of a higher capitalization rate, it will have a lower property price as investors expect higher returns because the property is considered riskier. Let us say the annual income of a property is 60,000 and the investor wants a 7% capitalization rate. So to find the price of the investor should pay for the property, we should divide the net operating income of 60,000 by the capitalization rate, that is 7%, and that is equal to 857,000 approximately. So with the 7% capitalization rate, the investor would pay approximately 857,000 for the property. So if suppose the capitalization rate is not 7%, but say it is 9%, now that means with a higher capitalization rate it will have a lower price, and I will show you 60,000 divided by 0.09, that is 666,000 approximately again. And the reason is that there is a higher expected return and there is a higher risk as well. So cap rates are subjective and can reflect an investor's belief in the potential risks and returns of a property. Understanding this relationship can help you determine how much you are willing to pay for a property based on its income generating potential. Next, let us talk about negative leverage. Now, negative leverage occurs when the interest rate on a loan is higher than the property's capitalization rate. The cap rate is essentially the annual return you would expect to earn on an investment property based on its income and market value. So if the loan is say 7% and the cap rate is say 5%, you are paying more in interest on your loan than you are earning from your property's income. This leads to a negative cash flow and hurts your overall return on investment. So, in this given scenario, every dollar that you are going to borrow to finance the property is costing you more in interest than you are generating from the property's income. And this means your cash on cash return, how much you earn compared to your actual cash investment, is going to be lower because the money you are borrowing is essentially working against you. Now, why is negative leverage bad? The reason is negative leverage reduces the cash flow from your property because you are paying more in interest than you are making from rent or other property income. If you are depending on cash flow to cover expenses or make a profit, negative leverage can lead to more financial strain. So, if the property's performance doesn't improve via renovations or increased rents, etc., you could be stuck with a property that cost you more than it brings in. Coming to when does negative leverage make sense? There are certain situations where negative leverage might still be a part of a strategy, but it needs to be planned carefully, like value add strategy. If you plan to renovate or add units to increase the property's value and rents, negative leverage can be absorbed in the short term with the hope that the property will appreciate and provide higher returns. If you can increase or raise rents over time, negative leverage could be mitigated by higher income from the property. If you expect to refinance the property later at a lower interest rate, you could offset the negative leverage by reducing your monthly loan payments. So, how to avoid negative leverage? The only solution is that the cap rate is more than the loan interest rate. If you are investing for cash flow, ideally the property cap rate should be higher than the loan interest rate. This ensures that the property is generating enough income to cover the cost of the loan and provide a healthy return. Then lower loan to value. If you are concerned about negative leverage, consider buying smaller properties or properties with lower loan amounts. A lower loan to value means you are borrowing less, which reduces the impact of a higher interest rate. So, negative leverage is risky when your goal is consistent cash flow from rental properties. In today's environment, with higher interest rates, investors need to be more strategic about their financing and property selection to avoid being negatively impacted. If you are looking to make cash flow a priority, it is better to focus on properties that either have a cap rate that exceeds the loan interest rate or come with significant value add potential. Next, let us talk about net operating income. Now, net operating income is a financial metric that measures the profitability of a property or business after operating expenses but before accounting for interest, expenses, taxes, depreciation, amortization, etc. So, in other words, net operating income focuses purely on the income generated from the core operations of the business or property without factoring in the costs related to financing or taxes. The formula? No. It is total revenue minus operating expenses. So, the total revenue includes all income generated by the property or business such as rental income, sales revenue, service fees, etc. While operating expenses are the cost directly related to running the business or maintaining the property such as salaries, utilities, property management fees, repairs, and insurance. It does not include financing cost, taxes, or depreciation. So the key points about net operating income is it excludes non-operating expenses like interest on loans, taxes, and depreciation. It is a measure often used in real estate to evaluate the profitability of a property and is critical in property valuation. It gives investors and stakeholders a clear picture of how well the core business of property is performing operationally. Imagine you are analyzing an office building for potential investment, and the office building has 10 floors where and each floor rents for 50,000, and there is additional earning of 20,000 from parking fees and other miscellaneous, and there are set of expenses as well. So to determine the net operating income, first of all we are going to determine the total revenue, and that is 10 times 50,000, because that is the rent from each floor, that makes 500,000, and then there is an additional 20,000. So the total revenue is 520,000, and from this we are going to subtract the operating expenses, that is 50,000, 30, 25, 15, and 40. So if you sum up, the operating expenses are going to be how much? 160,000. So next we calculate the net operating income, and the net operating income will be 520 minus 160, and that is equal to how much? This is that will be equal to 360,000. So the net operating income is 360,000, and this means that the property is generating 360,000 in income after covering all operating expenses. This is the amount available for debt servicing if applicable, taxes, and it doesn't include any interest payments, loan repayments, depreciations, or taxes. Investors, they often use net operating income to evaluate the performance of real estate investments. For example, in this case, the capitalization rate can be calculated using the net operating income. We already know that the capitalization rate is net operating income divided by the property value. So that is equal to net operating income is 360,000 divided by the property value, that is 5 million. So that is equal to 7.2%. So this means that the property has a 7.2% return on investment based on its net operating income. So net operating income is a crucial metric for assessing the profitability of a business or property from its core operations. It provides a clear picture of how much money is being generated before factoring in financing cost, taxes, or other non-operating factors. In real estate, it is particularly useful for valuing properties and comparing them to other investment opportunities. Next, let us talk about negative net financial obligation. Now, negative net financial obligation refers to a situation where a firm or a entity has more cash or liquid assets than its outstanding liabilities. Example, debts. So, in other words, a firm has excess cash or highly liquid assets such that if it were to pay off all its liabilities, it would still have leftover funds. So this leads to a net financial position that is effectively negative in terms of debt, or the firm is in a net cash position. To break this down, net financial obligations, this is typically defined as the total debt minus cash and cash equivalent. Now, debt is the total amount of money the firm owes, which includes both long term and short term borrowings. Cash and cash equivalents, they include liquid assets, including cash, marketable securities, or other assets that can be quickly converted into cash. Now, negative net financial obligation occurs when debt is less than cash and cash equivalents. This means the firm has more cash or liquid assets than the debt it owes, so its net financial obligation is negative. For example, a company has a debt of say 100 million and cash equivalents are 150 million. So the net financial obligation is 100 minus 150, that is negative 50 million. And in this case, the company has a negative net financial obligation of 50 million. This means the company has enough cash and liquid assets to pay off all its debts and is still left with 50 million. Coming to the implication of negative net financial obligations, the firm is in a strong liquidity position. It can cover its debt obligations and still retain a significant buffer of cash. This makes it more resilient to market downturns and reduces financial risk. While holding excess cash can provide a safety net, it could be considered inefficient capital management if the firm is not using the cash to generate returns. Investors might question why the company isn't deploying the cash into productive investments or returning it to shareholders. A negative net financial obligation means that the firm has negative leverage. This can affect financial ratio and performance metrics. For example, return on capital employed or what we also call it ROCE decomposition. A negative net financial obligation could lead to a reduction in leverage effects as the firm isn't relying on debt to generate returns. Then excess cash holdings might result in lowering returns because the firm is holding non-operating assets like cash and marketable securities that do not earn as much as productive assets or investments in growth. Why does a firm end up with a negative net financial obligations? A firm can end up with negative net financial obligation for several reasons. One is profitability. The firm generates consistent profits and accumulates cash. The firm may have a strategy of avoiding debt or paying down debt faster than it incurs new debt. The company might choose to invest in highly liquid assets like marketable securities instead of investing in growth opportunities. The firm may not be investing heavily in physical assets, leading to higher levels of cash accumulations. Consider a technology a company that generates large profits and has minimal capital expenditure needs. Over time, the company builds up a large cash reserves, perhaps from retained earnings, but doesn't take on much debt to finance operations or expansions. So, if the company's cash holdings exceed the value of its debt obligations, it would have a negative net financial obligation. This can be seen in some tech companies like Apple, which historically has had large amount of cash on hand compared to its debt. So in these cases, even though the company may have debt, its net financial obligations could be negative because of its substantial cash reserves. To conclude, a negative net financial obligation is a sign that a firm has more liquid assets than it owns in debt. This situation is typically a sign of strong financial health, as the firm has the ability to pay off its debt and still retain significant cash reserves. However, while this can be a sign of low financial risk, it can also indicate that the company might not be utilizing its capital as effectively as possible, particularly if those cash reserves aren't being deployed to generate higher returns. Finally, let us talk about the difference between negative net financial obligations and negative leverage. So, definitely there is a difference between negative net financial obligations and negative leverage. Even though both the terms deal with financial obligations and leverage, they describe different aspects of financial performance and risk. The term negative net financial obligation refers to a situation where an entity, usually a company, has more assets, financial assets, than liabilities, resulting in a negative net financial obligation. Essentially, it implies that the company has more cash or liquid assets than it owes in terms of debt or other financial liabilities. It is a balance sheet matrix. It suggests that the company is in a strong liquidity position. A negative net financial obligation implies that the company's financial obligations are outweighed by its assets like cash, marketable securities, so it could theoretically pay off its liabilities with its liquid assets and still have money left over. For example, if a company has 50 million in debt but 70 million in cash or liquid assets, its net financial obligation would be negative 20 million. Coming to negative leverage, it refers to using borrowed capital debt to increase the potential return on investments. Negative leverage occurs when the cost of debt exceeds the return generated by the investment that the debt is funding. This situation erodes shareholder value instead of enhancing it. It is a concept tied to investment returns and financing cost. Negative leverage generally suggests that borrowing is not yielding a positive return and it can be harmful to a company's performance. It often occurs when the return on an investment are lower than the interest or costs associated with the borrowed funds. For example, a company borrows 10 million at an interest rate of 8% and invest it in a project that yields only 5% return. Now, in this case, the company is experiencing negative leverage because it is paying 8% interest on borrowed money but only making 5% on its investment. So, the key differences: first is the focus. Negative net financial obligation is more about a company's overall financial health, specifically the relationship between its liquid assets and liabilities. Negative leverage deals with the efficiency of borrowing and investing and focuses on whether borrowing funds are generating a positive or negative return. Negative net financial position obligation typically signals a strong financial position. More assets than liabilities, which is generally favorable. A negative leverage is an undesirable situation because it indicates that borrowing is not profitable, reducing shareholders' value and profitability. So, to summarize, negative net financial position, they have more assets than liabilities. This is a sign of good liquidity. Negative leverage, that is, borrowed funds are yielding less than the cost of borrowing, resulting in reduced profitability. So, this completes the video on capitalization rate, negative leverage, net operating income, and the difference between negative net financial obligation and negative leverage. We hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel and hit the notification bell button to alert you for the latest video. For all of your questions, comments and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah, I will reply you back. Thank you so much and happy learning.